For a long time, the advice was simple. Pick a diversified portfolio, leave it alone, and let time do the work. And for a generation of investors, that approach delivered. Markets climbed, bonds cushioned the downturns, the strategy held. But something has shifted. And a growing number of people following that same playbook are quietly watching their assumptions fall short. Not because they did anything wrong, but because the environment those rules were built for doesn't look quite like this one. The question isn't whether patience still matters, it does. The question is whether patience alone is still enough. Hi, I'm Larry Sprung with Midland Financial, and I want to be careful about how I frame this because the goal today is not to scare anyone away from long-term, disciplined investing. That still works. It always will. But there's a version of long-term investing that has quietly crossed the line from disciplined to disengaged. And in today's market, that distinction carries real consequences. Today, we're walking through three things. One, why some of the foundational investing rules most people grew up with don't fully apply to the environment we're in now. Two, when passive, hands-off investing can actually work against you. And finally, how to stay thoughtful and strategic without falling into the trap of overreacting or trying to time the market. And I'll be sure to share a story along the way that I think will feel familiar to a lot of long-term investors. So let's jump right into number one, why the old rules don't fully apply anymore. The classic investing framework was built on a set of assumptions. Stocks go up over time, bonds offset stock risk, a diversified portfolio balances itself out. Stay the course and you'll be fine. Those principles aren't wrong, but they were stress tested in a very different environment. For decades, falling interest rates provided a tailwind that lifted both stocks and bonds simultaneously. When stocks dropped, bonds typically rallied. The 60-40 portfolio, meaning 60% stocks and 40% bonds, became the gold standard of balanced investing precisely because that relationship held up. In 2022, it broke down. Stocks fell sharply. Bonds fell at the same time. Investors who believed their portfolio was diversified discovered that the protection they assumed they had wasn't there when they needed it most. Research from Morningstar found that the traditional 60-40 portfolio experienced one of its worst calendar year performances in decades in 2022, raising significant questions about whether the conventional diversification framework remains adequate for today's rate environment. This isn't a reason to panic, it's a reason to reassess. The rules didn't fail because they were bad rules. They failed because the world changed and a lot of portfolios didn't. Number two, when passive investing can work against you. Passive index investing has been one of the great success stories in modern personal finance. Low cost, broad diversification, consistent performance that beats most active managers over time. The case for it, it's real. But passive investing has a quiet problem that most investors don't see. When you buy a market cap weighted index fund, you're not buying equal exposure to the entire market. You're buying more of whatever has already gone up the most. Today, the S&P 500 is more concentrated at the top than at almost any point in modern history. A handful of mega cap technology companies now represent a disproportionate share of the entire index, meaning investors who believe they own the broad market are actually carrying significant concentration risk without even realizing it. An analysis by Goldman Sachs found that the 10 largest stocks in the S&P 500 now account for a historically high share of the index's total weight, a level of concentration that creates meaningful vulnerability if sentiment shifts in that narrow segment of the market. The irony here is that passive investing was designed to reduce concentration risk. And in today's market, it may be quietly creating it. That doesn't mean abandoning index funds. It means understanding what you actually own and whether your overall allocation reflects the diversification you think you have. A woman we've had the privilege of serving for many years, let's call her Nancy, recently shared a story with me about her best friend, Sam. Back around Liberation Day, when the market was reacting to the tariff news, the headlines were loud. Your phone's lit up, every alert sounding worse than the last, and your brain starts telling you, do something, protect yourself, get out before it gets worse. That's exactly where Sam found herself. So she pulled all of her money out of the market and went to cash. And listen, I get it. I understand why. In moments like that, cash can feel like safety. But sometimes the move that feels safest in the moment is the one that costs you the most over time. The problem is the market does not warn you before it recovers. A few days later, the market had one of those powerful rebound days. The S&P 500 jumped about 9.5% on April 9th, 2025, after the tariff pause was announced. That kind of move can change the whole picture for a long-term investor. And because Sam had stepped out, she missed gains she may never get back. That is what makes market timing so dangerous. Some of the best days in the market tend to happen right near some of the worst days. Think about that. The days that scare people out of the market are often sitting right next to days that can make a meaningful difference. And once you miss those days, you do not get a redo. That's why staying invested matters. Not because we ignore risk, not because we never make changes, but because volatility is the toll we pay to invest. The mistake is treating volatility like a signal to run. In those moments, you have a choice. Stay connected to your plan or let the emotion of the moment make the decision for you. And that leads right into the third point. Feeling nervous in that moment made sense. The risk was not the feeling. The risk was letting that feeling drive the decision. Point 3, how to stay strategic without overreacting. If the answer isn't set it and forget it, it also isn't watch it obsessively and trade constantly. Research consistently shows that investor behavior, not investment selection, is the single biggest driver of underperformance over time. The Dalbar quantitative analysis of investor behavior found that the average equity fund investor has historically underperformed the S&P 500 by a significant margin over a 20-year period, largely because of poorly timed emotional decisions to buy, sell, or switch. The answer sits between the two extremes. It starts with a genuine portfolio review, not a panic-driven overhaul, but an honest look at what you own, what it's actually exposed to, and whether it still reflects your goals, your timeline, and the environment you're investing in today. It includes intentional rebalancing, not guessing where the market is headed, but systematically adjusting when allocations drift meaningfully away from your targets. It means stress testing assumptions, asking whether your portfolio has been built for a world that no longer exists, and making thoughtful corrections before conditions force your hand. The goal isn't to be reactive, it's to be awake. A strategy that made sense 10 years ago, left completely unchanged in today's environment, is no longer really a strategy. It's just inertia with good intentions. Set it and forget it had its moments. For the right investor in the right environment, it worked beautifully. But investing has never been a static exercise. Markets evolve, correlations shift, concentration builds in places you don't expect it. The most resilient investors aren't the most active ones. They're the ones who stay engaged, stay honest about what their portfolio is actually doing, and make adjustments with intention rather than emotion. That's not market timing. That's just great stewardship. If you've been running the same investment strategy for years without really revisiting whether it still fits where the market is today or where you are in life, that's worth a conversation. Because the cost of staying on autopilot isn't always obvious. Sometimes it shows up gradually in returns that don't quite match expectations, or in risk you didn't know you were carrying, or in a portfolio that was built for a version of the world that has quietly moved on. At Midland Financial, we help you take a clear-eyed look at what you own, what it's actually exposed to, and whether your strategy is still built to support your goals in today's environment. Not with dramatic changes, but with the kind of thoughtful, deliberate adjustments that make a real difference over time. If you're ready to take a fresh look at your investment approach, we invite you to reach out to us at Midland Financial to start that conversation. If you found this valuable, give the video a like and subscribe to the channel for more insights on planning with intention. I'm Larry Sprung with Midland Financial, where we strive to bring joy to your money journey. Thanks for being here.